Hi, good afternoon, everyone. We'll just give a few more minutes for others to join before we start. Thanks for holding on for a second. Good afternoon, everyone. We will go ahead and start the call. Thank you for taking the time to join today's earnings release update for Hela Holdings, covering our first quarter results. My name is Adam Collins, General Manager of Corporate Affairs and Investor Relations for Hela. I'm also joined by our Group CEO, Devanka Jinadasa, and our Group CFO, Rowan Fernando, as well as Savindia Tissera and Christine Jesudasan from our Investor Relations team. So to outline the agenda for today's call, we will start with a brief presentation of around 15 minutes, focusing on our latest financial results, which were published yesterday. We will then move on to a Q&A for the remainder of the session. Questions can be shared through the Q&A box on your screen, and we would encourage you to send these questions in as we go through the call. You will also be able to raise your hands and we'll be able to unmute you to answer any questions you may have during the Q&A session. We will also be sharing this presentation by email following the call, so no need to be concerned on that. And finally, a quick disclaimer on forward-looking statements before we begin. So any such statements are based upon the management's current reasonable expectations and assumptions and are subject to known and unknown risks. Given the risks and uncertainties that may cause the company's actual performance to materially differ from that expected or implied by these statements, we advise you not to place sole reliance on them. We also do not undertake any obligation to update these statements to reflect future events or circumstances that may arise. And with that, we will move into the presentation. So this initial slide gives a snapshot of our results for the first quarter. And it goes without saying that was a particularly challenging opening quarter to the financial year. So revenue, what you see there, has declined to 17 billion, which is about a 30% drop year on year. So that's primarily the result of about a 26% decline in our underlying US dollar export sales, as well as the appreciation of the rupee. So on a year-on-year basis and on a period average basis, the rupee was about 6% stronger in Q1 compared to last. So that's also a factor there. But of course, the biggest factor is that drop in our export revenues. And that is coming off continued weakness in consumer demand that we're seeing in our key markets in Europe and North America. And that's very much reflecting that household incomes remained under pressure during the quarter from elevated inflation, albeit coming down, as well as also the continued increase in interest rates in those regions as well. There are some other factors at play there. We're seeing a continued shift in spending towards services that is coming at the expense of goods, but certainly that overall economic environment is what's really pushing down on demand. And so primarily due to that drop in sales, we saw that's had a significant knock-on impact on profit margins. So what you can see in this slide is there was a significant decline in the gross margin, and that is really primarily coming from capacity underutilization or lower capacity utilization, more or less across our manufacturing base. And I will show kind of more detail on, or add some more detail to that in the subsequent slides. In addition to that, that has knocked on to contributing to a negative EBIT margin. That was fairly significant. That's primarily coming from the gross margin decline. There is an additional factor there in that while distribution costs have reduced, there has been an increase in administration costs. That is also coming in there, which is partly due to some of the SAP related costs as well. From a balance sheet perspective, it was mostly stable during the quarter, but we did see a slight nudging up in the net debt to equity ratio from about two times last Q1 to 2.1 times this Q1. And that is partly reflecting kind of major financing transactions or financing agreements that we've announced over the past couple of quarters, which has contributed to that nudging up. And I will have more to say on those particular financing agreements a little bit later in the presentation. To move on to the next slide, so I won't dwell on this slide too much because it more or less covers the points which I've just outlined. I'll just touch on this slide on the right-hand side, which is a bit of a change up from previous quarters, where we are showing the evolution over the past 5 quarters of our revenue composition by country of manufacture. Right, so the takeaway from this chart is that the story of last year was kind of a declining importance of Sri Lanka, or declining contribution, shall I say, from Sri Lanka, really coming off that higher contribution from Kenya, and also the increasing contribution from Egypt. And so what you're actually seeing Sri Lanka increasing in the right-hand bar for Q1, that's really reflecting a relative resilience in demand for our Sri Lankan manufacturing capacity, which is reflecting the customer mix allocated into Sri Lanka, which I will also touch on a little bit more in a later slide. This next slide is just really to put the quarterly results into some context in the performance over the past few years. So what we're seeing is that on the left-hand side, so the revenue chart, really the shift in revenue we're seeing is really a return in rupee terms to about what we were seeing in the FY 21-22 financial year. So it's still a little bit up on that, but certainly the sharp shift in demand we saw in Q1 has really hit into operating profit, which you see on the right-hand side, which is contributing to that very significant operating profit or operating loss in Q1 as well. So to dig in a little bit more on kind of what exactly that's driving that and how that looks from a capacity utilization perspective, what I'm showing on this chart is the sold standard hours. So really that was how we would measure our output in each quarter over the past 3 quarters. So Q3 through to the latest Q1. And that is shown at the group level and then split by each country of manufacture that we have in the group. So at the group level, what we're seeing is that while we saw a bit of a pickup in Q4, that really has dropped back in Q1. So we saw about a 15% quarter-on-quarter decrease. I should say that some of that is seasonal, because April there's a lower number of working days, particularly in Sri Lanka, but also in our other operating countries. But certainly the drop is still there. Aside from that, from where exactly that drop is, hitting hardest, what you'll see on the chart is that Sri Lanka is actually has proved a little bit more resilient in terms of the standard hour output in Sri Lanka, compared to Kenya, where we're seeing a drop, and also Egypt, where we saw a drop. And that is reflecting a skew in the manufacturing mix in Sri Lanka towards European supermarkets, compared to Kenya and Egypt, which are a little bit more exposed to US brands, which are more dependent on wholesale channels. So we're seeing the European supermarkets being a little bit more resilient from a demand perspective. And that is coming, though, at the expense that we're seeing that drop in output in Kenya and Egypt. So from a capacity utilization standpoint, if I take Q4 to Q1 at the group level, we saw capacity utilization rates drop from around 80 back down to 70%. But that is much more skewed, I would say, towards Kenya and Egypt, for the reasons that I've just outlined. To touch now, moving on to kind of the additional impacts we were seeing into operating profits. So this slide is intended to give you a bit more of an idea on admin expenses and also distribution expenses. So just to say that these charts are shown in US dollar terms, and that is because our functional currency is US dollars. So this to kind of abstract a little bit out of the exchange rate effects for the purpose of clarity. So to start on the left on administrative expenses, so that is showing administrative expenses over the past 5 quarters. So what you'll see is there has been an increase in dollar terms over the past 2 quarters. So that's reflecting a couple of factors. One is the exchange rate appreciation that we've seen in Sri Lanka. So particularly in quarter-on-quarter terms, that was about 15%, which is contributing to that increase you see there. There is also an element of our SAP implementation costs, which are also contributing to that figure. That's about $250,000 contributing to that as well, that increase. And that increase in administration expenses has offset what I would say is a normalization of distribution expenses. So if we look at the chart on the right-hand side, which we've shown in the past couple of quarters, which is distribution expenses split into 2 categories, one being unplanned air freight, and the rest of distribution costs being grouped into the dark blue line. So while we had an escalation in unplanned air freight costs last year, we've seen a significant improvement from an operational standpoint on that, which has really reduced that back down to more normal levels. And we would expect that to continue in future quarters as well. So that is primarily it for the quarter. I just wanted to say a few things on the kind of additional funding facilities that we've established over this quarter and last. So of course, last quarter we covered Norfund. And this quarter we announced an additional financing facility with an impact investor, which is India-based, but also very present in Africa, which is Avishkar Capital. So we have agreed a long-term debt facility of up to $5 million. And that is to primarily support bringing our Egypt operations up to full scale and fulfilling the CapEx requirement there. So these are, for the Hela Group, I would say both very landmark financing transactions and really demonstrate the confidence of these respected stakeholders in the business and in the outlook for the business. I think the additional caveat I would say is that, so while these are contributing to a slight increase, some increase in leverage, these are, if I take 14 million from Norfund and 5 million from Avishkar Capital, these are not being drawn down in their entirety all at once. These are to be drawn down as we require. So you will see an increase in long-term debt, but it's not going to be to this extent, and certainly not immediately. I'm just going to move on to the outlook. So, I mean, as we covered in the review that was provided with the quarterly accounts, the challenging operating environment it's certainly continuing. We're seeing some, let's say, stabilization of demand, but still demand weakness. And I would say, the brands are also being quite cautious in how they approach their procurement decisions, because there is a lot of uncertainty in how demand is going to play out. There is increased optimism right now because inflation rates are coming down, that interest rate cuts might come next year. But it is also the case that, even continuing interest rates at this level, still has the potential to cause a recession in some of our key markets. And if inflation doesn't come down as people expect right now, we could see further increases, which really further putting additional pressure on consumer spending. In addition to that, in the last few months, we've seen a lot of major climatic events, which have disrupted a number of activities. We haven't seen any major impact from demand coming off those, or even indeed on supply. But to the extent that those continue, that is another kind of risk factor that we see on the horizon. So in this context, with a challenging operating environment and uncertainty about when we are going to see a meaningful recovery in demand, we have internally taken a decision to launch a comprehensive group-wide strategy under the title Project 180, which is aimed at responding to this situation to ensure that we have a sustainable return to profitability based on conservative demand projections, so being less dependent on expected and significant recovery in demand. I'll kind of break that down into four major pillars we're looking at. So the first major one is on cost and capacity rationalization. So since about July last year, we have not been replacing labor turnover at our factory level, particularly in Sri Lanka. We've also extended that kind of recruitment freeze up to the executive level. There's only selective replacement at the executive level. And then we are also across the company working on mandated cost reductions to ensure that we return to profitability based on those conservative demand forecasts. I think we are also considering additional measures on both the cost and capacity side. And I think we will have more to say on some of those significant measures in next quarter as well. The additional pillars to this strategy is, of course, on operational excellence. So what you saw on the distribution cost slide is that significant kind of normalization in distribution costs, supported by the reduction in air freight. So that continued focus on ensuring that we are really removing any unbudgeted operational costs is key, as is the process improvement that we are going through now, particularly supported by our new SAP S/4HANA supported digital core, which is now live across the group as well. On the demand side, it is really about how do we continue to offer what is incomparable products and services to our customers. It's really never been more important that we are listening to the needs of our customers and responding. And I'll give an example actually on the next slide. We also have to be particularly aggressive in our approach to winning additional business, and it is in the industry you cannot stand still, and that continues to be the case and is all the more so in a demand environment like this. And then the final pillar is on strategic investments. So while this is a very challenging operating environment, and we are seeking to take the measures that are necessary to navigate through that in a sustainable way, we don't want to neglect kind of our future positioning. It is important that we are continuing to look at strategic investments that will leave us well positioned for the long term and build additional value. So that is something we are continuing to do, and as and when those come to fruition, we will be communicating those to shareholders and to the public more broadly. And I think that's really about responding to the fact that the apparel industry is rapidly changing, and that some of the old models, back to purely focusing only on manufacturing, are not going to be as viable in future. So we need to evolve also as a company to make sure that we're ready. I think just to give you one additional slide to kind of explain how we are providing incomparable service to our customers to ensure that we are winning additional business. So this is an award that we won from Tesco's, which is one of our largest customers. In the last quarter, this is the Tesco Empowerment Award. And so the reason we won that award is because we helped Tesco to identify a need, which was that they saw a trend picking up within the season that they weren't really prepared for in terms of having the product already ordered. So we worked with them on a concept to delivery within 7 weeks. So that compares to an industry standard lead time of about 14 or even more, right? Which enabled Tesco to have that product on their shelves in season and take advantage of that trend, right? So that's really the approach, really demonstrating the importance of our strategic customer engagement approach, and that we have to continue driving constant innovation in our service offering. And it's, it goes, well beyond price. That is just one of the factors. It's about how we support our customers more broadly. So I think I will stop there. We have a few more slides on some updates on our social capital projects, which I won't run through, but you're welcome to ask any questions after the slides get sent out. So that is all we have on the presentation side. So we can move to the Q&A session now. So I think we've already had a few questions in, but please feel free to send more in as they come up. So I think maybe if we take the first one, which is on expected capacity utilizations in the upcoming quarters, maybe John, if I can hand that to you to cover kind of a bit more on the demand outlook for future quarters.
Sure. Thanks, Adam. I think Adam briefly touched upon how difficult it's been to get a pulse of the market, because there's a lot of mixed results that we're experiencing. There are certain brands and categories that have recovered and some who are below, or rather drop is higher than what the average for the rest of the brands tend to be. So it's a lot of mixed results, making it even more difficult to kind of plan for the future. But overall, what we're seeing from Q3 towards end of Q2 and Q3 onwards, our capacity utilization tends to hover around 85–90%. But I think what we've got to also emphasize here is that we have reduced our capacity quite tremendously over the last 12 to 15 months. And this is at about a 90% utilization of that reduced capacity. As to when we will get back to the volumes we achieved in 2022, it's really hard to commit or mention at this point. But what we are doing in return is we're trying to leverage on those relationships, to leverage on our offering, and then trying to see whatever business that exists, how do we make sure that it heads towards Hela's way.
Thanks, Blanco. Another question on if you take out the currency movement, what would be the financial status in USD? Maybe Rowan, if you want to take that one. Maybe if we can talk about the kind of impact on the bottom line from the exchange rate appreciation that we've seen.
Yeah, so actually we have had about a $400,000 impact for the quarter in terms of currency movement, because on the overhead we have about $2.2 million worth of local healthcare overhead per month, equivalent USD value of about $2.8 million. So if you take it out, if you take the currency movement out, it will be about $400,000 positive in terms of bottom line. So this will, we believe this will continue for the next 9 months as well. But it won't be that significant as compared to Q1, because Q1 average was about 314.
Yeah.
But now it's 320, so we don't see the impact to be great. And also the rupee may depreciate based on the we will now, there's a lot of relaxation in imports that the government is talking about, so this will get negated.
Okay, thank you, Rowan. Maybe, Rowan, if you don't mind, a couple of other questions on the borrowing side.
Yeah.
So being on, what is the split between floating rate and fixed rate borrowing?
We don't have any borrowings from banks in terms of on floating rates. It's all fixed. We have floating rate borrowings from non-banking sector, which is Avishka especially, and Norfund, which is again pegged to SOFR. So if you take the total from Norfund and Avishka, it will be about, as of now, it's about 11 million, 10 million. So our total borrowing is about 80.
Should be about 19.
Total borrowing is about 89 million. So it's about 10 million was 10 over 89. So which is about 8% roughly.
Then there's an additional question in relation to borrowing, which is on the split between local and foreign borrowing, which I think the best way to answer it is probably on the split between LKR and USD borrowing.
I would say about 90% is on USD and about 10% in LKR.
And I think maybe on average, there's another question on average loan installment payments for the upcoming quarters. I think one kind of additional major point to mention on both the Norfund and the Avishka facilities that they both come with grace periods on principal repayments, which is pushing out that immediate kind of impact of those. And so then on the balance of our remaining long-term debt, the installment payments shouldn't be that significant.
I don't have the figure as of now, but can be
$1 million per quarter. $3 million.
It's about $300,000 mark.
There's an additional question on the SAP impact, which is the administration expenses increased due to SAP amortization only, even though we don't see an increase in non-current assets.
So now SAP is basically, now we will be capitalizing it as of 31st March of this financial year. So and we had about about 800,000 rupees worth of expenses capitalized. Can you go down to question? Yeah, so we haven't still capitalized, so it will be reflected in the capital work in progress in the balance sheet. So if we haven't capitalized it as of 31st March and 30th June, it's still appearing in the capital work in progress.
Yeah. There's also a question on SVAT, as to whether we have had any impact based on the abolishment of the exemption for SVAT.
So we will have a cash flow impact because we will not be able to get the vouchers against it. But since we don't, now it will be on our LKR rate, which is about $2.8 million a month. So 15% of that would be the cash flow impact on SVAT.
Take the next one.
Yeah. So a question on, based on the current drop we're seeing in demand and the increasing gearing of the company, what plans do we have to negate this challenge?
Right. I think this is what Adam mentioned by Project 180. So our current, at a very high level, our current break even is hovering around the $20.5, $21 million sale per mark. What Project 180 will help us achieve is to reduce our break even to a target level of $18 million. So that even in the depressed revenue forecast that we see, that we will be able to achieve profitability even at that level. Our internal goals is to get that going before the start of the third quarter. I'm going to have the structure in place before the start of the third quarter. So there's a lot of work to do in order to achieve that. And a lot of tough measures that we will have to take. But that's certainly one of the key projects for the leadership team here at Hela to complete this so that we have a sustainable profitability in the current levels. And once revenue does recover above that $19-20 million mark, then of course, we will enjoy improved profit margins. Just to again give you some context, our run rate last year was hovering for most part of the year around $24-25 million. So our overhead reflects a business of that size. So now it's about, now that we have a bit more clarity as to the recovery time period, we know that it's not going to recover over the next 6 months or so. So it's time for us to shift gears and structure the business accordingly.
Thank you, Tamanka. Couple of questions in relation to Forex gain and losses, maybe, and how that impacts us. Maybe, Rowan, if you could give a bit of additional explanation on how exchange rate movements impact the financial performance.
So we have actually hedged our positions till about August. So we are actively looking at entering into forward contract based on the exchange rate movements, but up to August we have hedged. Beyond that, we are still looking at the market movements, and based on that, we will go into forward exchange contracts so that we can minimize on our exchange movement.
I think just to add to that, just to ensure clarity, so our accounts are prepared on a US dollar basis. That is our functional currency. But obviously, in our operating countries, we have reasonably significant local currency costs, so Sri Lanka being the biggest. We would see, obviously, manufacturing overheads in all our operating countries denominated in local currency,
Correct.
Which would have an impact then coming into the USD.
So given we have operations in Ethiopia and Egypt, there could be a significant impact in terms of currency losses. But Egypt, we have managed to secure certain local borrowings to negate that. Sri Lanka, again, as I said, we will be looking at hedging to minimize the exchange impacts in future.
Yeah, just to maybe follow up on that. So there was a question on the devalue or the depreciation of the Kenyan shilling recently, and whether this will have a significant impact in Q2. Maybe everyone.
Yeah,
it's about a 20% depreciation that we've achieved. I mean, when you look at a 1-year horizon, what we've seen is that when you do have currency depreciations, you may have a short-term margin improvement, but generally a lot of the devaluation gets eroded through inflation, local salary increments, or even the customer asking for a part of that benefit. So we don't really believe that devaluing improves margins. It helps you absorb some of that inflationary pressures, but it's definitely not a margin driver in the medium term.
So I think that's all we've covered all the questions that we've got so far. We'll give 1 more minute for any additional questions anyone wants to submit before we bring the call to a close. Okay, we've not received any further questions, so we will wind up the call. However, if you do have any kind of questions that you'd like to follow up with us on, you are very welcome to reach out to us via the investor relations email address. And as I mentioned at the start of the call, we will be sending out the presentation slides to everyone shortly today. So you can also review those in more detail. It just leaves me to say thank you very much for your time today and joining the call, and we look forward to speaking to you again next quarter.